And you've been covering the banking sector for a long time now. After the global financial crisis, it seems like there was very little innovation as the banks were busy cleaning up their loan book. In the last 5 years, though, it seems like there has been a burst of innovation, and one such innovation is peer to peer lending. Could you explain what these peer to peer lending platforms are and what explains their emergence?
Well, I think at first we need to take a step back and look at what banks do on a very basic level. When you really boil it down, all banks are doing is they're taking in deposits and making loans, and they're earning the majority of their income on the difference between the loan rate and the deposit rate. What peer-to-peer lenders do is they do arrange those transactions, but they're actually pairing up individual borrowers with individual depositors. And instead of earning a spread or collecting a spread on the difference between the loan rate and the deposit rate, they're actually earning fee income. The reason why I think they've emerged, though, is that the regulations and the amount of paperwork and compliance work that banks have to do is really stifling their profitability. And peer-to-peer lenders are not regulated at that level yet. Another reason why they've emerged is that this model is entirely internet-based. They don't have to have a branch network. They can do this all online, so it's much more efficient.
In your view, do these peer to peer lending platforms pose a significant risk to the banks, either in terms of their existing business or maybe even potential future business?
I don't think they're going to pose a big threat to banks in terms of their growth. They may win some market share around the edges, but in many cases what we're looking at are people who may have been rejected by the banks. When they apply for a loan, they're deemed to be too risky, and peer-to-peer lenders may be their last resort. Banks are happy to give up this business because they know full well that when the credit cycle turns, and it eventually will, that these customers may prove to be a source of non-performing loans and a lot of risk to their balance sheets. I think one of the issues that could come about is if there is an increase in credit losses, this could spook the depositor base, and investors in loans would all of a sudden become concerned about ultimately whether they're going to get their money back. And this could lead to a stampede out of this type of an arrangement, and that could put an end to the growth in this business model altogether.
Are there any broader lessons that the banks could learn from the emergence of these peer-to-peer lending platforms?
I think they already have learned from it. If I go back maybe 4 or 5 years ago, I think the banks were kind of caught flat-footed, and some of the inroads that the fintech companies, the payments companies, and the peer-to-peer lenders were making was definitely a surprise to them. But I think many of them have really reorganized. They've made some cultural shifts in-house. Many have really taken the forefront and have put themselves in a position where they are a threat to some of these companies. They can actually do it better because they have existing relationships, they have existing distribution, and they have deep pockets that they can use to spend behind these initiatives.